Nvidia, U.S. Treasuries, and the American consumer. Hello, members, super savers, and bond course fans. I hope you're healthy and well. So I'm sure you're thinking, what do Nvidia, U.S. Treasuries, and the American consumer have in common? Well, that is what we'll be talking about today, because all three of these will help us answer the ultimate question in this video, which is part one of our two-part Recession 2024 mini-series. What has our country done right so far? And why hasn't a U.S. recession happened yet? And in part two of our Recession 2024 mini-series, we'll be covering even more and equally important questions. What could go wrong? How could the U.S. economy, including the bond market, stumble from here? Plus, are you foolish to buy U.S. Treasuries? And how are we changing our strategy going forward based on the findings from our Recession 2024 mini-series? Part two and the answers to these questions will be coming in a few days' time. And I'll include the link to that video in the description below as soon as it's ready. So for today, part one, Nvidia, U.S. Treasuries, and the American consumer. And what has our country done right so far? And why hasn't a U.S. recession happened yet? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Many industry experts expected a recession to happen in 2023 and are now predicting one for 2024. In fact, a little less than a quarter of our community also expect a recession for this year, as you can see from this recent poll here. No surprise, since the yield curve has been inverted since the summer of 2022. An inverted yield curve is when yields on shorter maturity debt are higher than yields on longer maturity debt. Bond masters, folks, please refer back to Module 3, Bond Ladders and Other Bond Strategies, for a brush up on inverted versus normal yield curves and why inverted yield curves have historically often been predictors of oncoming recessions. And yes, the yield curve is still inverted at the time of this taping, with 10, 20, and 30-year treasuries yielding significantly below short-dated T-bills. So, that said, in our mind, there are three fundamental reasons why a U.S. recession hasn't happened yet. The first reason is what we at Diamond NestEgg refer to as the big I, innovation. Innovation is the key reason why America is number one in the world economy. Now, we all have been exposed to the sometimes loud background noise of doom and gloom from voices who talk down our country. And there are some very real and potentially damaging stumbling blocks out there for our economy, which we will be discussing in some depth in part two of our Recession 2024 mini-series, as I said before. But let me be clear. The United States of America, which issues the U.S. Treasuries that many of us own in our portfolio, the United States of America has been the number one winner in the world economy over the past 20 years. As you can see from this chart from the Wall Street Journal, with its data sourced from the IMF, the International Monetary Fund, the U.S., this black line here, the U.S. will account for 26.3% of world gross domestic product, GDP, in 2024 at current prices and exchange rates. This is the highest share in almost 20 years. China has also done fairly well over the past 20 years, as you can see from this nice upward sloping red line here. The IMF expects that in 2024, China's GDP will be about 64% of the size of the U.S. economy. However, back a few years in 2018, China's GDP was already even a bit bigger in relative terms at 67% of the U.S. economy, meaning that it has slipped a bit post-pandemic. Overall, our country's winning position in the world economy has left the European Union and Japan behind, and has also been keeping China at a distance. In fact, the EU and Japan have been the two big losing economies over the past 20 years. As you can see, the EU, this blue line here, which also includes the UK, They used to have the #1 share of world GDP, ahead of the US. Fast forward 2 decades, and it's now a somewhat distant #2 to the US. And Japan, this mustard yellow line here, fell from #3 in the world to a distant #4, and will be overtaken by India soon at current trends. India, this green line here, has grown steadily over time and has been increasing its share of the global economy. But despite its potential and huge population at existing growth rates, it will remain far behind the US, Europe, and China for the foreseeable future. And because I know at least some of you will ask, do note that these GDP numbers here are based on current prices and exchange rates. So the current relative strength of the US dollar will make the US economy look good because $1 will buy us about 7.2 yuan at the time of this taping, while back in late 2013, early 2014, it was only slightly more than 6 yuan. Now, some people would argue that based on purchase power parity numbers, or PPP, meaning if we measure the purchase power of earnings in a country, China will mostly show as a bigger economy than the US overall. Now, I am of Chinese descent, I love cooking Chinese food, and we celebrate Chinese New Year in our family. But let's face it, as an investor, it doesn't really help me if 1 yuan in China buys me 2 hamburgers and that $1 in the US buys me just 1 hamburger. PPP and the standard of living in China don't really matter to me when I think about my portfolio. What matters to me is that I buy bonds, equities, and everything else in actual US dollars, not in PPP dollars. And that if there is a base currency of exchange, it is again the US dollar for all practical purposes. And it's not just me. In the world of markets for oil, food, microchips, or even handbags, you name it, everyone has to pay in actual US dollars at current exchange rates. And that's why GDP numbers are generally based on current prices and exchange rates, and not on PPP, which is mostly used to compare standards of living. Did I lose anyone here? Gross domestic product, purchase power parity, and exchange rates are not always straightforward subjects. So if these are topics that some of you find interesting, confusing, or you simply want to learn more, then drop a comment below and let us know. In any case, back to our country's pole position in the world economy. America's #1 position in the world economy is also clearly reflected in the stock markets, where US firms dominate the rankings of the most valuable companies. At the time of this taping, 12 out of the 15 most valuable companies worldwide, as measured by market capitalization, are American, and most of them will be household names to many in our community, and even the world. For example, Nvidia with its AI and next-generation microchips, and of course Microsoft, Apple, Alphabet or Google, and Meta or Facebook. Amazon even manages to make its global impact felt in 2 areas as different as retail and cloud computing at the same time. In fact, only 3 of these 15 most valuable companies worldwide are not American, with 1 company each from Saudi Arabia, Taiwan, and Europe, Denmark specifically. And the first Chinese company on the list here doesn't even make the top 15. So if stock markets really indicate future growth potential, as is the general assumption, this speaks for the continued strength of the US economy. Because the United States' strength in innovation does not just make companies valuable, it also translates into high output per head, a high GDP per head. If we look at GDP per head, the US, this yellow line here, has historically outpaced the other large economies. Japan, this blue line here, was close to overtaking the US's GDP per head in the early 2010s. But since about 2012, the US has really pulled ahead of everyone else. So, our country, the United States of America, is clearly the undisputed leader in innovation globally. And our companies have been driving global developments in many different industries over the past 2 decades or so, especially since the great financial crisis of 2008-2009. Being at the forefront of innovation means that every new contract moving a European or Asian company into Microsoft, Google, or AWS cloud, or more prosaically, onto their servers and data centers, has been driving business and jobs to the US. And there's no real sign that this fundamental technology-driven dynamic will stop anytime soon. If anything, the innovation gap between the US and other countries appears to be widening even further. According to Techopedia, our country currently tops the list in the emerging AI research and technology sector, with 60% of all top-tier AI researchers in the world and an estimated $249 billion in private funding raised to date. And this innovation, with companies like Nvidia, Microsoft, Apple, Alphabet, Meta, and Amazon, is the first fundamental reason why US recession hasn't happened yet. Let's move on to the second fundamental reason now: government deficits. So, I know that our growing debt pile can become a real problem, and we'll be diving deeper into this in part 2 of our Recession 2024 mini-series, when we focus on how the US economy, including the bond market, could stumble from here. Because let's face it, while we can all be a little bit proud of our strengths in innovation, large government deficits and an ever-growing debt pile is nothing to write home about. For this video, though, let's look at government deficits from a somewhat different and less viewed lens. How it's actually supporting and helping the US economy currently. Government spending is stimulating investment and job growth in both the public and private sectors. In a statement from the White House last year on the Inflation Reduction Act, if we scroll down, we can see that in the first 12 months after the Inflation Reduction Act was signed into law, the private sector announced more than $110 billion in new clean energy manufacturing investments and 170,000 jobs. And the law is projected to create 1.5 million additional jobs over the next decade, according to estimates by outside groups. In addition, the CHIPS and Science Act, passed by Congress in 2022, falls into both the government deficits and innovation buckets that explain why a US recession hasn't happened yet. Again, according to another White House press release, this time from earlier this year, because of the CHIPS and Science Act, companies have announced over $240 billion in investments to bring semiconductor manufacturing back to the United States. America will produce roughly 20% of the world's leading-edge chips by the end of the decade. Regardless of how some of us may feel about our growing mountain of debt, about clean energy, about AI taking over the world, the fact remains that at least some of these US Treasuries that many in our community are buying, at least some of this government spending is directed into productive investments and supports the private sector and the overall US economy currently. So that was the second fundamental reason why US recession hasn't happened yet. Government deficits and the public and private sector growth, that government spending that our US Treasuries have helped to fund. And by the way, if you're interested in learning how to invest in treasuries, agencies, or corporate bonds issued by some of the innovative companies we've been talking about, then check out our 2 recently launched bond courses in the video description below, because rates like these, they won't be around forever. In any case, let's move on to the third reason why US recession hasn't happened yet, and that's consumer spending. We, meaning the American consumer, we keep buying more and more stuff basically. All we need to do is take a look at the economic data from the St. Louis Fed. At the end of the first quarter of 2024, consumer spending accounted for 67.9% of GDP. Some of this consumer spending is supported by government payouts, and so indirectly by our growing deficit that we just discussed. And some of the spending is coming from savings. Our personal savings rate across the US is lower than it was pre-pandemic, as you can see here. But the good news is that we don't seem to be funding our spending by taking on more debt than usual. Household debt service payments as a percentage of what we earn is actually lower now than it was pre-pandemic. It seems that the inflation in wages, services, and other areas combined with the high personal savings rate during the pandemic has so far translated into higher consumer spending without necessarily the need for consumers to pile on a larger proportion of debt, unlike our government. And while retail sales were flat last month, it remains to be seen if this was just an anomaly. In the words of the Fed,
we need more data.
So, Nvidia, US Treasuries, and the American consumer, what do they have in common? Well, they stand for innovation, government deficits, and consumer spending. The three fundamental reasons why US recession hasn't happened yet. They also show what we've done right so far and why the US economy has been pulling even further ahead of economies such as the EU, Japan, and even China. Today's Recession 2024 Part 1 video has really only looked at the sunny side of things for our country, so to speak. And it paints a really pretty picture for our country, why America is number one. We focused a lot on innovation because this is the hardest for most other countries to replicate, especially at the current rates at which the US is out innovating everyone else. And innovation will likely be the key driver of our long-term economic growth for many years to come. But long-term economic growth does not necessarily mean there won't be some short-term economic pain, or possibly something even worse, especially when we look at government deficits and consumer spending. And a great economic performance over the past 20 years does not necessarily guarantee future success. And who knows, maybe this video did jinx it for the US economy and a deep recession is just around the corner. But let's touch wood and continue our Recession 2024 mini-series with Part 2, where we will tackle these additional key questions that look at the potential downside for America. What could go wrong? How could the US economy and the bond market stumble from here? Plus, are you foolish to buy US Treasuries? And how are we changing our investment strategy going forward based on the findings from our Recession 2024 mini-series? As I mentioned at the start of this video, Part 2 will be headed your way in a few days' time. I'll also link it in the video description below as soon as it's ready for you. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And if you did, I'd love to invite you to take a look at this video here on one of our two brand new bond courses so that you can take advantage of some of the current higher for longer rates on those US Treasuries and other fixed income products I shared with you in the previous section. Or join our next live member Q&As on Monday, May 20th at 5:30 p.m. Eastern Time. And in June to continue the discussions. Check out the links below this video for more details on our bond courses and YouTube Super Saver membership. See you again very soon with more brand new wealth building content for your financial journey.